So we've had many down stock markets, but when stocks and bonds are down at the same time, that's a rare event. Makes it hard for people who are not working, not earning a steady income. Where do we get cash when we don't have anything to sell? Fortunately, thanks to our investment team, we did have things to sell, but it's been a tough year. So tonight's agenda, we're going to look at what caused 2022 to happen, what moved the markets, potential headwinds in 2023, tailwinds in 2023, and then ultimately opportunities.
I think the main headlines that people felt or saw or read in 2022 that really were some of the most impactful on the U.S. markets, thinking about U.S. equity markets, the U.S. bond market, were inflation and the Fed. I don't know how many people tracked the Fed before last year, but that became a everyday occurrence to look at, okay, are they going to raise this month? How much are they going to raise this month? So when we look at inflation over the past really 2 years, it's the highest it's been since the early 80s. It's been coming down recently, but we still ended the year last year at 7.1% with the November reading on core CPI or on CPI. And so that is a 12-month number, so that's thinking from November 2021 to November 2022, inflation was up over 7%. It had been up over 9, 10% earlier in the year when you're looking back a year. So it's trending in the right direction.
We saw the numbers on the prior one. Inflation was high. Central banks were raising interest rates aggressively to try to combat inflation. You throw a little gasoline on the fire with Russia invading Ukraine. That caused a huge spike in an already increasing price of oil. And that just put continued upward pressure on inflation. Inflation was assumed to drop as we went through the year, but all of those upward pressures continued to keep it elevated and continued to keep the Federal Reserve with a very aggressive posture in the way that they were trying to approach it with interest rate policy. What that boiled down to for the investment markets was that there was really nowhere to hide. You don't worry about the text on the screen if you can't read it from your seats. Visually, you can see almost all traditional asset classes had negative returns last year, pretty meaningful negative returns. And so I joked about commodities earlier. That spike in the price of oil gave the commodity index a favorable return. But stocks and bonds, even if you were in a conservative investment strategy that had a significant exposure to core bonds had a meaningful drawdown last year, the worst drawdown in any of our lifetimes. And so if you've been to these events over the past few years, you've heard us use the term uncharted waters that we've been sailing through. And in some respects, last year may have been the deep end of some of those uncharted waters. Fortunately, we did have some defensive assets in our portfolios and your portfolios. And so the experience that most of our clients had was a little bit cushioned, but still, certainly if you've looked at your numbers, still a very meaningful drawdown versus where we started the year.
Let's move on to the asset classes. Something like 95% of asset classes were down in 2022, just a whopping number. Dennis, would you like to comment on this?
Yeah, as has been said already, not something we see every day, and almost a perfect storm across the board. In some of our scenario work, dating back a few years, we looked out ahead and said, okay, eventually these interest rates are going to rise. Now again, as PJ pointed out, even the people making those decisions, 10 out of 12, didn't call what actually happened in 2022, but we kind of thought it would happen over a few year period of time and maybe soften the blow a little bit. And again, you could argue, well, Ukraine, maybe that was the trigger point, whether it's food inflation or energy inflation or other things, that was the trigger point. Well, there were a lot of trigger points. And that compressed perhaps 3 years of interest rate changes into one. And so that's the shock and awe that you see on the screen of 95% of asset classes being negative last year.
A lot of those asset classes that were down for 2022, you actually saw some improvement in them kind of Q4 2022. So gold was up in 2022. You're starting to see international equities do really well, for example. Things like that have actually started to perform well over the last 3 or 4 months. But I do think, especially one point that PJ made, some of those residual impacts of the pandemic are still very much within the economy. And I don't think we're at a point now where it's going to be smooth sailing. We're going to be very much in fits and starts during the recovery. I know that even if you look back to December, one day we get an inflation print, and then the next day the Fed comes out and says they might have to continue to hike rates. And so the first day the market went up 2%, the next day it went down 2%. So you're seeing this volatility continue to be persistent within the markets, unfortunately, and it's very news dependent. However, I do think there are some trends within inflation, for example, that Dennis alluded to that are starting to turn more positive. Generally a bear market's 6 to 18 months or so. Some go out to about 24 months. So we're about 12 months into the current bear market, and so I think that kind of looking out, we'll see some volatility Q1, Q2, but hopefully we'll start to see recovery in full force come latter half of this year. So.
Visually, you can see that the growth cycles in the market are orders of magnitude bigger and much longer in duration historically than the down bars, the periods where the stock market was in an actual bear market. We were in that bear market last year. We haven't quite got out of it overall, still in that drawdown phase. The market could still be volatile in the near term. You know, we're not going to tell you that we're out of the woods already. But from a mentality standpoint, when we start to see these drawdowns and when we see the market down as much as it has been, we want to start to shift our thinking into being, where are the opportunities going forward? If we do expect that next phase of the market cycle to have strong positive returns, when that's going to start, that's anybody's guess. Maybe it's already started. Maybe it starts 6 months from now when we have a little more pain before we get there. But at some point as the market's going through this bottoming cycle, we want to start to shift our thinking to where are the opportunities, because what's going to be most meaningful for all of our portfolios long term is participating in those green bars, participating when we have those growth cycles in the economy and in the markets.
Jason, if I may just interject briefly, I think, again, the visual is striking in that regard. If you look across there and look at how many times we've actually had a red bar, those are the bear markets when stocks were down more than 20% from their peak to their trough. Dennis and I had the opportunity to meet with a client who recently turned 94 years old earlier today, and we got to point out that in the entirety since 1925, there have only been 11 bear markets. There have only been 11 times when you had the chance to enter into stocks after a significant discount. So we want to begin to move our mentality in that direction.
U.S. bonds, the U.S. investment grade bond market, high quality bond markets returned almost 5% per year for almost 100 years. Last year was an outlier. We do not expect that to happen this year. Again, right now we're sitting at, on the 10-year, around 3.5%. Shorter term bonds are upwards closer to 5%. And so your starting point is pretty good. Does that produce a positive return this year? We do not know, but there's a much better chance this year of earning positive returns than there was last year when you're starting out close to 0% interest rates for many of your bonds.
The magnitude of the bond loss is exceptional. It's 101 last year. I think in 2018, stocks were down 3 or 4%, bonds were down 1 or 2 kind of thing. So both stocks and bonds this year were down 10+%. So if you're, you know, in a vanilla 60-40 portfolio, there was really nowhere to hide last year. There was no diversification within stocks to bonds last year. The only other times that happened, you've had very minimal losses in bonds versus stocks. So your total return was still in a 60-40, not negative 15 or 16. It was more like negative 5 or 6. So.
Historically, again, going back almost 100 years, there have only been 11 calendar years where bonds have lost money. And in that orange section, the biggest loss prior to last year was only about 3%. And so last year was a very uncharted and unprecedented event in the bond market. Inflation was rearing its head, highest it's been in nearly 4 decades. The Federal Reserve was being extremely aggressive, raising interest rates from a zero interest rate policy coming out of the pandemic. Still dealing with supply chain issues as a leftover effect of the COVID pandemic, and having geopolitical risk back in the equation in a meaningful way. All of those things combined to push asset prices meaningfully down last year.